Priyanka madam,
Huh?
we can start the session now.
Okay. Good afternoon to one and all present here on the virtual dais. I, Professor Priyanka Deshmukh, on behalf of MCT's Rajiv Gandhi Institute of Technology and Department of Mechanical Engineering, welcome you all for third day, second session of phase 2 of AICT AQI sponsored online 1-week short-term training program on recent trends in energy management and audit. Topic for the session is financial analysis of energy conservation projects. It is my privilege to introduce our today's resource person, Mr. Vinayak Gadikar. He has completed his B in Mechanical from SRT Marathwada University, Nanded, PGD in Business Management from Symbiosis International University, Pune, and also pursuing his Master's in Business Law from National Law School of India, University NLSIU, Bangalore. He is a certified energy auditor, Bureau of Energy Efficiency GOI, and ISO 5001 ENMS lead auditor. He has more than 10 years of experience in the field of energy and resource conservation, energy efficiency, and energy management, and also renewable energy. He has conducted training of energy management in various reputed industries, PSUs, government organizations in India, and also abroad. He's currently the director of Green Flame Private Limited, Pune. I welcome you wholeheartedly, sir, and request you to share your knowledge with us. Over to you, sir.
Thank you, Priyanka, for this nice introduction, and thank you for having me on board for this introduction. Uh, I hope I'm comfortably audible. Uh, there can be a bit of noise around. If it is very high, just let me know.
Sure,
Because
sir.
right now I'm sitting in the client's place because of the already committed audit is going on. It's for ISO 50,000 right now in Mysore, with Indian Railway Workshop over here. Well, at the outset, let me also express this is a bit feeling certainly comfortable for me to discuss something or conduct a training session or teachers for academicians. Generally, my trainees come from industry mostly. Of course, their age varies. People having 5 years experience to 25, 30, 35 years experience uh, can be there. I rarely have conducted training for, or never have conducted the training for academicians. So this is first time I'm coming across it. So it's a bit testing time for me. It's going to be. So I look forward to a interactive and cooperative session. Yeah. So as it was being discussed in my, can I present? Okay. For more than 12 years, I'm working in the field of energy efficiency and renewable energy. Uh, and It can be consultancy for energy audits. It can be projects of energy conservation. It can also be energy management system implementation and conducting the audits for ISO 50001. So in any capacity, sometimes or most of the times it is also regulatory audits for Bureau of Energy Efficiency in India, ESOS in UK, or many other regulatory bodies in different countries. So may it be individual effort, may it be industry initiative, may it be government program. wherever we go and do these energy audits and come up with the recommendations, finally, the decision comes down or boils down to the financial part of it. So, and that is precisely very important, because very important as well for energy professional to understand this financial analysis. I know there is always apprehension to go for it. Being an engineer, we rarely go for it, or we try to avoid it. Even I have the experience that we also don't. We are also not very happy in filing the energy returns on ourselves. So we want that to be done by the CA or somebody else who is dealing with it. And it is but natural. But still, to make the sensible recommendations, understanding the finance part of it helps a lot. That is why when it was asked to me what can be the session, I propose if I'll be happy to share uh, my experience and also some of the techniques of financial analysis. Thank you for accepting my proposal and allowing me to discuss on this particular topic. So here are a couple of links. I can do is I can share these links in the chat box. So later on, you can have a look at it. Fine. Okay. Now in the chat box, I already have put one uh, compound interest table for all of you to use during this particular session. These links you can refer later. Okay, they will give you some better insights about how the financial interest analysis is done, particularly the concept of compounding and discounting is explained very well. So why to study this financial analysis? I said finally the buck stops at the desk of the financial officer, CFO. So however lucrative something look like, however environment friendly, eco-friendly, and green initiative it can be, finally it stops at the desk of the financial officer, CFO, whoever is taking care of the finances. So the questions that one has to face, like how much will be the proposal cost, how much money will it save, there are different qualification for investment opportunities. Uh, we may have more than one proposal and we need to prioritize them in phase one, phase two, phase three, or first year, second year, third year, for having the assessment of financial risks regarding the investment. So doing the investment, going for the lucrative project, but then what can be the inherent risk? Technical risk is fine, that can be taken care by the technical guys, but there can be also financial risks. Typically, when the proposal goes for ESCO, for PPA kind of agreements, then communication of energy conservation measures in monetary terms to the top management. So many of the times, the people from the top management may not be technical and need not to be always, but they are running the show, they are conducting the business. So we should be able to make it or help them to understand it, comprehend it in monetary terms. And what are the year-on-year monetary benefits, so that we should be able to put correctly. There are different techniques. One very simple technique we always know is simple payback period. So where we try to understand in how many years we are going to get the money back, whatever investment we are putting in. Second is looking at it from return on investment, ROI point of view. So return on investment is percentage. Okay, I have seen people using payback period and ROI
Hello, sir.
replaceable to each other. Hello,
Sorry to interrupt you there. Your screen PPT is not visible, sir.
screen is not visible. So are you able to see only me on the screen?
Yes, sir.
So none of the screens were visible since beginning.
No, sir.
Now is it visible? The PPT is visible.
Yes, it is visible.
Now it's visible, sir.
Okay, okay. I'm sorry, I should have confirmed that in the initial itself. So anyway, this is the title slide from where we have started with. These links I have shared with you. Okay, we discuss these questions. Now we are here. Is it okay? Are you with me now?
Yes, sir.
Yes, sir. Yes, sir.
That's great. Thank you. Uh, well, so there are different techniques. We were talking about the simple payback period and return on investment. Uh, I have seen sometimes people using simple payback period and ROI, return on investment, for each other, but it's not so. Return on investment is percentage. How much return, how much percentage of return we get on the investment. There is also something called savings to investment ratio. Then NPV, net present value, uh, interest rate for of the returns, sorry, internal rate of returns, IRR, and then life cycle cost analysis. So these are different techniques or tools you can say, which are used to understand or analyze the financial and analyze the proposal financial. And these are used for different purposes as well. Okay, so we will go one by one and we will try to understand when they are used. And if time permits, we will also like to make some number crunching here, uh, see how they are used, okay, how the calculations are. Start with the simple payback period. So this is a simple measure of how long it will take before the investment makes money. Okay, so if I invest, let us say something like 100,000 bucks, and how many years I'm going to get that back? 2 years, 3 years, 5 years. So that is simple payback period. So used as a rough first cut tool to access the initial possibility of an investment opportunity. Where the after more detailed assessment, it can be finalized. So you may hear that if you go with proposal, you will you will get a feedback from the management that come to me the come to me with the proposals which are having simple payback period of less than 2 years, less than 3 years, less than 1.5 years. Okay, so there can be 10 or 20 proposals. Only those who are having payback period less than 2 years will be discussed further and prioritize using different tools. So it becomes first cut or go no go kind of decision. Okay. It also provides an answer in years. So when you'll get the break even, okay, for the investment. The formula is capital investment divided by annual net savings. So again, same example. If you okay, here is the example, and we can solve that. So I would advise all of you to use some calculator. In worst case, if you don't have any calculator with you, you can use the calculator available in the mobile phones. Okay, you don't need the scientific calculation. It is simple calculator you can use. Understand this. So a cogeneration system installed in is expected to reduce company annual energy bill by 23 lakhs. If the capital cost of the new cogeneration installation is 90 lakhs and annual maintenance and operation cost is 5 lakhs, what will be the expected payback period for this project? So if we have to solve this, what is the capital investment? Can somebody answer?
90 lakhs.
Right. So 90 lakhs is the installation investment for installation of this cogeneration plant. So that is capex. And what is the annual net saving? Okay. So Can somebody volunteer to say what is the annual net saving here?
18 lakhs, 23 minus 5, uh,
Perfect.
5,
Perfect.
5 towards the maintenance. So 23 minus 5, 18.
Perfect, Rehan. So, right. So the gross savings is 23 lakhs, and at the same time, there is cost of operation and maintenance, that is 5 lakhs. If we subtract that, so whatever is the net saving, that is 18 lakhs. Now, going by the formula, what will be the simple payback period?
Yes, sir. Can you repeat? Didn't get your question.
Yeah, if we put these things in the formula for the simple payback period, which is equal
Okay.
to capex divided by annual net savings. So, how much will be the simple payback period here?
5 years.
Perfect. I'm just putting my camera off so I get all the bandwidth to communicate. Right. So the simple payback period becomes 5 years. That means you are going to get your investment back in 5 years. Right. So it is very simple. So it becomes very advantageous, uh, both conceptually as well as from application point of view. Get the two numbers, divide them, and get a number which is in years, or sometimes it can be in the months as well. Right. You multiply 5 with number of months per year. So within 60 months, you're going to get the money back. So obviously, a shorter payback period indicates an attractive investment. Okay. So a project with 2 years payback period is better than a project with 3 years payback. The shorter the payback period, earlier you're going to get your investment back. So that is the simple way in which use it. But it's not all that, because there are some areas where payback period doesn't help us to identify which is the right investment. The payback period does not consider savings that are accrued after the payback period has finished. So if we say a project is having 2 years payback period, so what are the savings after 2 years? Okay. It also favors the project which brings substantial cash inflows in the earlier years and discriminates against the projects which bring the substantial cash flows in the latter years. So, so there can be two projects. Now here we can see project A and project B. So in scenario of A, the cash flows are given. In scenario of the project B, the cash flow is given. Investment is same, okay, 100,000 or 1 lakh rupees, and it shows that project A will get the money back in 3 years, and project B will take 4 years to get all the money back, right? But if we see the savings in fifth and sixth years, the project B is going to earn handsome money. Project A is having only 5 years life, whereas project B is having more life. Okay, so if we see the picture incomplete, then of course the project B is better than project A. But if we use the tool of simple payback period, it tells us that the project A is going to be the preferred project, right? So that is the catch in using simple payback period. Now, if that is not to be done, then there is other tool, that is return on investment. Sorry, yeah, return on investment, ROI. So ROI is calculated by the formula of annual net savings divided by capital investment. So it is inverse of payback period in a way into 100. So that gives you the percentage. Okay. Now, if you have a cash flow, and if you make it average per year, okay, the example shows you that an outlay of 1 lakh rupees for equipment is expected to provide an after tax cash flows, so that is final saving of 25 rupees over a period of 6 years without significant annual fluctuations. So it is average outcome, average saving. What is the return on investment? Now, if we put it in the same formula, we will get return on investment is equal to annual net saving is 25,000 divided by capex, capital investment, that is 100,000, 1 lakh. So, in percentage terms, can somebody volunteer to tell how much will be the return on investment?
25%.
It would be 25%. Sure. So, now we get this in percentage terms. ROI has an advantage, like it is again equally simple. It's not much complicated calculation, and returns are expected in percentage terms. So it becomes very easy to evaluate it against the borrowing interest. So if we are investing in particular project, and if we are borrowing that money from bank, financial institution, we have a CC, okay, then so what is the percentage at which we are borrowing? That percentage should be less than what we are getting. Okay, what are the returns we are getting on that particular project? So we are borrowing at let's say 12%, and the project is giving the returns at 15%. It makes sense. Anything above 12 makes sense, and anything below 12% would be incurring the losses in the long run, right? So that way there is benefit in return on investment. The disadvantages include it does not take into account the time value of money. Okay, so it treats all the 25,000 rupees for first year, second year, or maybe the fifth year or 10th year as same. The measure will give the same answer whether the economic life of the project is 1 year, 10 years, 100 years. So the life would also not matter. It also does not account for the variable nature of annual net cash flows. So 25% here, which we have seen, returns indicate an example, indicated in this example, would be economically valid only if the investment yields 25,000 per year. Practically, it may not be so. It's not very realistic. Okay, so the returns vary each year because each year the fuel cost varies. The new fuel cost will also vary if you have altered the fuel itself. So, so it is not very realistic in that sense. Though it is better than simple payback period, still it doesn't reflect the true financial picture. Okay, so hope everybody is with me. I would encourage everybody to speak out whenever you have any doubt, if something is not clear, or if I'm rushing fast. Till now the things were simple, so I'm rushing fast. So we get good time to understand the things which are not that simple. Now let us understand the cash flow diagram, or practically how the cash flow happens. Okay. So this is a typical cash flow diagram wherein we are dealing with a project which is having a life of 8 years. N is equal to 8 years. Okay. So today we make an investment. Okay, P stands for capex, or capital investment, and it is shown in negative because we are spending that money, right? Zero there, the 0 day we are spending, making the investment, and then year on year we are going to get the benefits. This is called as annuity. That is nothing but annual benefits equally spaced over the life. Average saving that we get every year. It's like EMI we pay every month. Similarly, we have this annual savings that we get. Okay, we go further, then there are some additional elements in the cash flow. Apart from savings, we also have some expenses during the project life. They can be for maintenance, they can be for a rebuild, some retrofitting, reconditioning required. Okay. At the end of the project life, we can dispose of the project. Either we sell it and we get some money, salvage value, or we may incur some cost in disposing it. If you take the example of the vehicles, so at the end of its passing, so 10 years or 15 years, for a typical passenger car, 15 years we can say. If we have to sell it, either we have to get it repassed or we have to dispose it of. So disposing is a cost. Okay. If we are able to sell it within the valid passing time, the registration is valid, then we get some value. So some salvage value. So if it is that you are going to get something out of it, then it is positive. If you have to spend to dispose it, it is again negative. Okay, so the life cycle, we have different cash flows, and they are indicated in this particular. Let us understand them one by one. Annuity. Annuity is a series of equal cash flows equally spaced occurring over a time span. Cash flows are counted at the end of the each year. Uh, it may happen any point of time in the year, but for the simplicity of calculations, they are considered at the end of the year. The actual buying power, this is something to understand. So the actual buying power of the equal amounts diminishes every year, which must be taken into the account. So let us say 100,000 rupees today will not be same down the year 10 years. Okay. So simply we can also understand what was the cost of 10 grams of gold we hear from our parents. So somewhere in the 90s, it was something like 1,500 for 10 grams of gold. Today, it is more than 30,000. So in this lockdown period, it went ahead more than 50,000. 57,000 was something that was the highest, right? Even if we discount these erratic effects of lockdown also, overall, the cost of gold has increased. In turn, we can say the cost of buying of our currency, that is rupees, has reduced, and it happens. There are many factors. Inflation is something that that reduces the power of buying power of the currency. Okay. So if we say the inflation rate is 10%, in turn we say that buying power of the rupees is reduced by 10%. Okay. So what to do for this to accommodate this? So there is a concept of time value of money. We need to understand the value of the money diminishes over the time. Today's money values less in future. For the same value, we need to spend more money in future than today. So 100 grams of 10 grams of gold has same value, but it is not the same money which is buying it. It was 1,500 back then in 90s. It is 35,000 or 40,000 today. So same value needs more money to buy. So whenever we are having a transaction in different point in time, then we conduct these operations to understand its real effect. Whenever we are making some expenses today, and evaluating its future value, we go on compounding. Whereas we think of the cash flows in future and want to evaluate it as per today, we go on discounting. Now you get a home loan today, but you may go on paying it with interest, compound interest. So you get a home loan of X value, but in turn, finally you pay something like 3x or even more than that over the period of, let us say, 15 years or 20 years. So that is because of the compounding. Similarly, that 3x is nothing but x today. So if we discount that 3x by the rate of interest, we will get finally x as of today. So that is discounting. The rate of compounding or rate of discounting is nothing but what is the interest rate that you are applying to that money. When you are getting that, it is compounding. When you are paying that, it is, sorry, whenever you are going to get that in future, you have to compound it. Whenever you are going to see the present value of future transaction, you have to discount it. To make it simple, we can represent it this way. So the present value, how much that would be in future, let us say down the line, 5 years or 10 years, one compounding. When it is future value you have, and you want to know actually how much that is going to be in future in today, then discount it. So sometimes it typically happens with LICs. Okay, so you have a policy, and while having the policy, you get to know that down the line 20 years, you will get some handsome amount in hand at the end of the policy. Looks very handsome today, but if you go on discounting with the typical inflation rate, you will find actually how much you are going to get. And generally, it turns out to be very little more than what you have paid in terms of your premium, annual premium for 20 years. Okay. So this jugglery we may not understand, but if we use the discounting concept and do the calculations, we will identify actually how much is the benefit that you are going to get. So this is used to get all the transactions in the on the same playing field, on the same level, and then comparing them. So here is a formula which is used. So when you want to calculate the present value, try to understand what is the future value, and then PV is equal to FV divided by 1 plus I raised to n. Here I is nothing but the discounting rate, the interest rate, okay, 10%, 12%, 15%, whatever is the interest. Raised to n. N is nothing but number of years you are considering. So if you know the future value down the line 10 years, use I and n. So I and if you have interest rate of 10% over that, then I will be 10 and n will be also 10 years. Well, the compounding tables which are shared with you help you to make this calculation easy. Okay, so if we think of a project where we have uniform returns every year, okay, for the simplicity, then let us say 10,000 every year is the uniform returns that we have for 10 years. Then the present value of these 10 years returns will be present value is equal to A, that is the annuity, 10,000 into a factor. So this factor you get from the compounding tables you have. We will see how to get that. Similarly, it is done the future value calculation as well. So FV is equal to the normal formula that is used PV into 1 plus n raised to n. Whereas using the compounding tables, it will be FV is equal to P, that is the initial investment, into a factor F by P. We will see how to get that FYP for a particular interest rate and for a particular period of time. So hope everybody is with me. There are 18 participants, including me. Me and coordinator subtracted, then there are 16 participants. Well, for the new participants, I have one attachment given in the chat box. So I should put it again. So I request everybody to download this. Okay. Is the presentation visible again?
Yes, sir.
Okay. Well, okay. Let us understand what is present value. Present value is the current value, current benefits in today's rupees of the future stream of cash flows. It takes into account the diminishing actual buying power of the benefits savings. If you see down there, there is the diagram, okay, which shows you the cash flows. First year, second year, third year, up to 8 years. Okay. Every year, though the cash flow is same, its buying power is going to reduce with a particular interest rate. Okay. When you sum up all of them, you get the present value of all those cash flows in future. Okay, because you are doing the investment today, you know how much you are investing, and whatever cash flows that you are expecting, benefits you are expecting down the line every year, you take the present value of each of them for that particular year. And if you sum up all of them, you get the present value of all the benefits for all those, let us say, 8 years in this particular example. Now you know what you are investing. Now you also know what is the present value of all the benefits. Now you can easily compare both of them. Okay, and this comparison will be pretty realistic. And then that can help you to take the decision whether you should go for it or not. If the net difference between the present value minus the present investment that you're doing is positive, it is the project which is actually beneficial. If this difference is negative, that means ultimately you're going to incur loss. And hence it will be negative. So it is incurring the losses, you should not go for it. Okay. So that's about the present value. Now we will surely understand it by doing it in future. Let us start understanding the different tools. Okay. So here is saving to investment ratio. We understood simple payback period. We also understood return on investment. Now it is savings to investment ratio. What is this? Savings to investment ratio takes the time value of money in account. Okay, it's better than more accurate than simple payback period. If the savings to investment ratio is more than one, project is cost effective. If it is less than one, then it is not cost effective. Okay. Savings to investment ratio is present value of the benefits divided by initial cost of the investment. How to calculate the present value? We have seen. You know the formula for that. So let us try to see how does it work. So if we know the capex is 1 lakh and present value of all the cash flows over the period of project life is 1.25 lakh. So savings to investment ratio will be present value of the benefits. What is the present value of benefits? Is 1.25 lakh divided by the initial cost of investment, that is 1 lakh. So the SIR is 1.25 lakh. Is it more than one? Yes. So the project makes sense. It is cost effective, right? If we have two projects which are having SIR more than one, then which is larger? That is more attractive. Okay. So one project is 1.25 having SR 1.25, another project is there having SR 1.5. So if we have to prioritize, we will go for project having SR 1.5. Okay. Higher the SR, better is the project. More attractive is the project. So now let us move further to understand what is internal rate of return. Before understanding that, so there are different terms which we should know. First is interest rate. Everybody of us know interest rate. Many of us may be paying some interest rate on some of the loans, maybe home loan or car loan. So the amount charged by a lender, bank, to a borrower for the use of the lender's money is expressed as percentage of principal. That is the interest rate. Okay. Generally, we have the interest rate in terms of percentage per year. So if we say interest rate is 10%, it is implicit that it is for 1 year, unless it is specified. Discount rate. The rate of interest used to determine the present value of the investment. Generally, if you are borrowing the money, same will be the discount rate that we have to use. If you're not borrowing the money, if you are investing ourselves, if you are funding the project on ourselves, then it will be then sometimes we can also use the bank rate. Sometimes we can also use inflation rate for discount. Okay. Now internal rate of return. So growth in money added when NPV is zero, expressed as percentage of principal. So what is NPV? NPV is net present value. What is net present value? So present value of benefits minus the capex is going to be the net present value. So at the rate of interest or rate of discounting, when the NPV is equal to zero, that is internal rate of return. So for a particular project, if we are investing 1 lakh rupees, the project life is 5 years, then and if we know so if we know the returns, annual returns, okay, so at a particular rate, when these annual returns are equal to the present value of all the annual returns is equal to the capex, that rate will be internal rate of return, or that will be acceptable internal rate of return. So for example, this the same example, if we are spending 1 lakh rupees and the project life is 5 years, and so ideally we should get 20,000 rupees every year to make it 1 lakh. But when we consider the diminishing value of rupees, it is not 20,000 rupees always. So it can be 22,000 for first year, it can be 25,000 for second year. So every year it has to be, the net present value has to be 20,000. So what is the discounting rate that we have to use to get this 20,000 every year? And that will be the internal rate. We will understand it better when we solve the example. Minimum attractive rate of return. MARR. Sometimes it is also called as hurdle rate. The minimum IRR a company requires to consider an investment opportunity. So company may say that I will only entertain the projects which are having IRR 20% or more. Then 20% becomes hurdle rate. Anything below 20% would not be considered for investment. Right? Similarly, uh, anything above 20% would be attractive. So it takes into account the risk. Higher the risk, higher is the required MARR. So, for example, for the retrofitting project, I have a minimum attractive rate of interest, rate of return 10%. But for replacement, I will have higher because you are taking out the equipment which I know, you're putting new equipment which I don't know. So it is higher risk. Okay. So then in that case, I will put more minimum attractive rate of interest. So if it is giving 20%, then only I will have it. So that is how we try to compensate against the risk, financial risk particularly. It builds in compensation for the risk taken, decision by the company management. So generally, these are put the minimum rate acceptable or effective rate of return is put by the finance department. CFOs generally decide this and give it to the company for the people who are proposing for the investments. So internal rate of return, going further, it focuses on the cash flows and takes into consideration the time value of money. Growth in monetary value added when NPV is equal to zero expresses as percentage of principal. It neglects to show a monetary impact on the business. Euros or the dollars or the rupees contribute to the business cash flow, not percentage. IRR is used to rank the projects in terms of how much return can be expected on an investment in percentage. But to determine the actual monetary value, addition in the euros or dollars or rupees to the company, NPV should be used and taken into account. So you have more than one projects. You want to prioritize, you can find the IRR of each of the projects and then priorities. Higher IRR projects are priorities first. But finally, how much benefit you will get out of each project. So for that, IRR will not help. You need to go with net present value method. See how does that work. So there can be some change in the currencies that we're using because I keep upon adapting or customizing this material of presentation for different audience. Sometimes the audience is international, so I use different units as well. Right now, further, the IRR indicates the efficiency of an investment. Okay, easy, making it easy to understand. A company should consider all investment opportunities where projects have higher IRR than the cost of capital as it has the potential to increase the profitability. Cost of capital is nothing but the interest rate that is being charged by the bank. Higher the IRR, the more attractive the project is. Okay, but consider the risk profile of the opportunity and be aware of the ability of the resources to manage the multiple projects. Okay, so two things. One is there is higher IRR, but there can be higher risk involved into that. The project may work, may not work. So that has to be considered. And also, If you have multiple projects, then your team should be able to handle them. So it indicates that instead of doing two projects of higher IRR, you can go for one project, which gives you more benefits. So that is prioritize. Calculation of IRR. Okay. So here is one opportunity where you have a capex of 1 lakh rupees. It's one-time investment you are doing. You're getting annual savings of 31,000 per year. Your maintenance cost per year is 4,700 rupees. So net saving will be 37 minus 4,700 rupees. The project life is 8 years. Okay. Just to put it in the financial terms that we understand. E, that is investment, is 1 lakh. A, that is annuity, is 31,000, but expected additional maintenance cost is 4,700. And N is 8 years. So for internal rate of return, we have seen the net present value should be 0. That means the capex should be equal to the present value of all the benefits. We know the capex, that is 1 lakh, and we have seen the formula of present value of all the benefits, right? So that present value is going to be present value of all the benefits is going to be calculated using this formula A, P by A for I and N. Okay, now the I is what we have to calculate. That is going to be the internal rate of return. What I would advise you is, if we put this in the formula, 1 lakh is equal to A is nothing but the saving minus the cost. So it comes to 26,300. And we have this formula and we have this factor which we will get from the table. So this factor should be equal to 1 lakh divided by 26,300. It comes to be 3.8. Now where is this factor? How to find? So wherever you find that factor for 8 years, okay, that will be the percentage, or that will be the interest rate. Now how to find that? So let us open the compound interest table that is shared with you. I hope everybody of you have that. Just download it, have it with you, and let me also open that. Can you see the compound interest table on your screen? Yes, somebody just tell me if the compound interest table is visible.
The time value of money tables is visible right now.
Is it visible?
Yes, sir.
So the presentation slide is only visible.
Ah, yes, sir. Only the presentation slide is visible.
So I think my screen should be visible. And now this is compound interest table. Can you see this?
Yes, sir.
Okay, thank you. Now here we have single payment series, uniform payment series, as well as arithmetic gradient series. We will be using uniform payment series. If you go further on each of these pages, on the left upper corner, you will find there is some percentage, okay, 1.4%. So this particular page is dealing with 1.4% of interest rate, okay, compounding interest rate. Now down there, you find three series: single payment, uniform payment, and arithmetic gradient. So we will be using only uniform payment series. This is a very standard table available. Okay. This is used by all the financial institution, all the banks, for all kind of loans. It is the same table that is used. Okay. So the only thing is we will be using the uniform payment series here. If we go down the left column, the first column you will find is N. N is nothing but number of years. The left as well as right number of years are given. So sections of 5 years each are given, which makes it easy to locate what we want to see. Okay. Now this table typically it works like, let me open something which we typically use. So 3%. So this is a page you can see which is for 12%. Okay. So hope you can identify this 12%. Okay. This 12% is what percentage? These are number of years. Now, if I have to ask you, tell me a factor P by A. Of course, we are seeing only uniform payment series. So tell me a factor P by A for fifth year. P by A for fifth year at 12% interest rate. So I'm asking you P by A for fifth year. Okay. So it goes down. So it's 3.605. Correct? Are you able
Yes,
to
sir.
locate it?
Yes, sir. 3.605.
3.605. So it tells you this is the factor by which you can calculate your present value. Now let us use let us see what we are doing right now. So hope you can see the presentation. Is the time value of money slide visible to you now?
Yes, sir.
Okay. Now we are here where we want to know the P by A factor for 8 years. Okay. It should be 3.8. So that is going to give us the percentage that will be IRR. Okay. Now, if we go in the compound interest table, okay, we have to identify the P by A factor for 8 years. It should be 3.8. Now here on the 12%, we have this P by A factor which is 4.9. Am I right? Let me go further. Let me see on the 15%. 15% it is 4.89. Yeah. So on the 15%, it is 4.487. Tell me how much is it on the 18%? Somebody volunteer to tell me.
4.078.
4.07 exactly. So let me go and see on 20%. How much is it?
3.8 year it is. So it will be 20%. 3.837.
3.8%. Right. Correct. Just let us check if there is any further precision available. How much is it on 25%?
It's
Becomes
3.32. So it
3.3.
should be 20% only because this will
Right,
deviate
right.
from
So
the
with
value.
the available information, it can be 20%. So at 20%, we have capex is equal to the present value of all the benefits. We have NPV 0, right? So 20% is going to be the answer. So 20% is the IRR, internal rate of return, for this particular project with these benefits. So for those who are doing this for the first time, it can be a bit exhaustive to comprehend. I can understand, but by practicing, it will be easy. It won't be that difficult always. Okay. So the answer is 20%. Anybody having any fundamental doubt, or anybody want to contribute anything in the discussion? Well, let us go ahead. If there is any doubt, please be open for the discussion. Now, determine the present value of the following investment opportunity. Now, let us try to use this table so we are thorough with it. So we have a capex of 50,000 rupees. We have annuity of 15,000, 15000 annual savings. Project life is 5 years and expected returns is 12%. So present value of all the benefits that we have, we will calculate using a formula, the same formula, A into P by A, for how many years? 5 years. And at what interest rate? 12% interest rate. Okay. So it will go like this. It is equal to annuity is 15,000 into P by A for 12% and 5 years. Okay. Now let us go to the compounding tables. You can open your own compounding table. Which page we will use now? In the compounding table?
15%.
Oh, what is the expected return?
12%. 12%.
12%. So we'll use the 12% page. And how many years? 5 years.
5 years.
So P by A on 12% and 5 years. What is the factor?
605.
3.605. Is everybody with me on this? So it is 12%, 5 years, P by A. Okay. This is how we calculate. We get the factor P by A. Okay. So everybody is following. Hopefully everybody is following. So 15,000 into P by A, that is 3.605. That is equal to 54,075. Right? So this is the present value of all the benefits. What is the capex? Capex we have done is 50,000, and today we are spending 50,000, and whatever the benefits we are getting in all the 5 years, today's value of those benefits is 54,000. So are we in profit? So the present value is more than the capex, right? Present value of all the future benefits is more than the capex. It is more by 4,075 rupees. Okay. So here we understand the concept of net present value. Okay. So we have the present value of all the benefits and capex. So the difference between the initial outflow of the money and inflow of the money, the expected future, so benefits over a period of time, that is going to be the NPV. Here in this particular project, the NPV was 4057, 4075. Okay. So if the net present value is positive, the value is added in the income as income exceeds the cost. If it is zero, benefits is equal to cost. If it is less, then no value is added, but net loss is incurred in that particular project. Okay. So the difference between the capex, net present value is difference between the capex and initial that is the initial cost and present value of the benefits. NPV takes into account the time value of money. NPV indicates the monetary value of a project is expected to add to the business. Okay, and NPV is equal to zero means the project does not leave money in the bank at the end, but the interest rate of this particular case can be referred as IRR, internal rate of return, or real IRR. Let us solve more examples. So here is determine the net present value of the following investment opportunity. Capex is 80,000, annual savings is 21,000, project life is 8 years, expected interest rate is 15%. So can we calculate the present value, and then we will calculate the net present value. So what is the present value of all the savings for 8 years? How will we do that? So we go this way. Net present value is present value of all the benefits minus investments. Present value is calculated by the formula annuity A into P by A for 15% of the interest rate and 8 years. Now this formula, in this factor P by A, we can get from the compound interest tables. We go for 15% table, and here we are calculating 15% to calculate P by A. Annuity is given, P by A we have to calculate for 8 years, right?
4.487.
Exactly. We go back here. Right. So 21,000 to 4.487 will give you the present value of the money, of the benefits that you have. So this is the present value minus this is capex. right? Where did we find the capex? Is given. So present value of the money minus capex would be saving. So this is rather this would be the net present value. Is it positive? Yes, it's positive. Is in today's monetary value. Okay. So the project is making profit finally. Is everybody with me?
Yes, sir.
Okay, so there is another tool which is used that is called as life cycle cost analysis. Okay. Now the life cycle cost analysis is more comprehensive tool than the net present value because it considers all the cash flows, positives and negatives over the life of the project. So it gives you the total benefits over the life of the project. Now, while doing all the ISO 50001 assignments, and many of the times with some of the regulatory bodies like ESOS in UK, um, some of the European bodies as well. So they prefer to go with this LCCA, life cycle cost analysis, okay, because that is more realistic. It gives you the comprehensive view of the performance, energy performance of the project in monetary terms. So it is so life cycle cost analysis is a decision support tool to determine overall cost of the ownership during the life of the project, identifies the most cost effective option between alternatives, also called as life cycle analysis, life cycle cost, or life costing, present value. So there are more than present value life cycle cost. So whatever with the term, the concept is same. Normally it is used where the initial costs are high relative to the future cost obligations. Uses NPV as approach. So it can sometimes be used without taking inflation into account for some federal projects. Okay. LCCA includes a broader scope of costs than NPV. It can include the energy and water price increases, environmental cost, replacement cost, residual cost, that is salvage values, resale values, disposal cost as well, financial cost, finance cost, taxes, carbon tax, rebates, no fuel operations, maintenance and repairs cost related to specific operation, and maintenance schedules. So all this variety becomes really difficult to estimate the use. Okay. So is it visible again? I think it was disturbed. The internet was disturbed.
Visible, sir.
Okay, fine. Uh, so there are some terminologies we will understand. Okay. The economic life. What is the economic life of a project? The expected period where an asset remains useful, feasible, and workable can differ from actual physical life of the asset. Okay. So it should be economically useful, feasible, and workable. Used for budget purpose, for both maintenance and risk of the breakdowns as well as replacement decisions. So, residual life analysis is also done for technical life availability, and also the economic life is considered to take the replacement decisions. Salvage value. Salvage value is the expected value of an asset at the end of the project life that can be raised. It can be positive through sellings, or it can be negative if the removal and disposal costs are to be incurred. Is used in the tax calculations for annual depreciation. See slides, straight line depreciation. So we will have the slides down there. And it is also part of generally acceptable accounting principles practices. So depreciation values are considered here. Annual worth and rebates. So annual worth method is used to evaluate the mutually exclusive projects of different lifespans. So we can use the NPV for the similar life. So we have two projects. For example, let us say we have two different solutions for the same problem. So we want to install a VFD on a particular pump. So we have two options. We go with the VFD of Siemens and we go with the VFD of ABB, just for example. Siemens VFD is costlier than ABB, but Siemens VFD gives more savings than ABB. So we use net present value. But if we have two different projects, one is putting VFD on pump and another is replacing the pump altogether. If you put the VFD on the pump, and the life of the VFD is 8 years, but if you replace the pump, the life of the pump is 15 years. Now, what is the beneficial? So net present value will not work. You have to go with annual worth method. So you have to see how much is the benefit I get every year. Okay, and higher the benefits, better is the project. Rebates. Rebates are the return of the part of the original payment purchase price by the seller or seller to the buyer. Sometimes the rebates are given by seller. Sometimes there are also subsidies given by the government. It's also known as partial refund, reduction, return on what has been paid. The examples of rebates in energy environment is provided. Depreciation. So depreciation is an accounting method of allocating the cost of a tangible asset over its useful life and is used to account for the decline in value. Normally, a formula set by the tax authorities is used. So we know in India we have something like 40% depreciation for all the electronic goods. So by end of 3 years, the electronic goods becomes zero value. So all the corporates generally change their laptops every 3 years because on their book values, those assets are of zero value. Okay. So they go on disposing them, get some money out of it, and get new laptops. So that makes more financial sense to them. Similarly, the vehicle has a disposal depreciation value, which is different. So, so every product or the goods are having, so there are different compartments in which they fit in. So there are 10% depreciation, 20% depreciation, 30% depreciation, 25% depreciation, 12% depreciation. So this is set by the tax authorities. Businesses depreciate long-term assets for both tax and accounting purpose. For tax purpose, businesses can deduct the capital cost of the tangible assets they purchase as business expenses. However, businesses must depreciate these assets according to the relevant tax authority rules about how and when the company can take the deduction. The term annual depreciation is also used to describe the amount to be considered for calculation purpose. Simple tax and straight line depreciation. Tax may have to be paid on the benefit savings of a project. Uh, so when you go on having some savings, you will have to pay the tax, but naturally. So how do you calculate your final benefit? So you get 10,000 rupees as benefit, but you pay 33% tax on that, 30% tax for simplicity. So you pay 3,000 rupees as tax. So your benefit is 7,000, not 10,000. Okay. So that is how you calculate your benefits after tax. Okay. Depreciation is not a cash flow, but an accounting entry with the tax implications. So local laws may also allow deduction for interest on loans for the initial project investment. So there is, for simplicity, we use something like straight line depreciation. So for example, we have an asset of 1 lakh rupees and the asset life is 10 years. So the straight line depreciation is 10,000 every year. Is used as an example for where the project costs are allowed to be deducted for the savings before a tax is calculated. Now, it is again same thing. So as we discussed, capex is 1 lakh and annual savings is 30,000. Economic life of the project is 5 years. So what is straight line depreciation? Straight line depreciation would be 20,000 per year, 1 lakh and 5 years, so 20,000 per year. Now, new taxable profit is you have 30,000 savings, right? And you have depreciation of 20,000. So how much tax will be there? So tax will be there only for 10,000 rupees. So whatever is the tax bracket you fall in, you will pay the tax. You will not pay the tax on all the 30,000 rupees as it issued in the savings, but you will deduct the depreciation of that particular year, and then you will have net saving, and on that net saving you will have the tax. You will attract the tax. So the tax is attracted here only on the 10,000 rupees and not on the 30,000 rupees. So there is a method of calculating the after tax cash flow. In the same example, if we have capex of 1 lakh rupees, annual savings 30,000 rupees, economic life is 5,000, and company tax rate is 35%. Okay. So what is the after tax cash flow? So we know that the tax is being applicable only for the 10,000 rupees. Here, if we see, the tax is being calculated for only 10,000 rupees at 35%, right? So, and total savings 30,000. So once you subtract this 35% of 10,000, that is 3,500, whatever is remaining, that is your net saving after tax. Okay. So that is after tax cash flow. Very complicated way of but when you go on the financial analysis, these are the details to which finance guys seated in your company, clients, finance guy will always be calculating. So these are the different tools which are used for doing the financial analysis. I know it was a bit fast, okay, and there was very less interaction in this discussion. It became more of one way discussion. But to be honest, there are people who are having career spent in the financial analysis. Chartered accountants, CFOs, doing this in very detailed manner. Is the only work they do. So this is just a beginning for us to understand these financial terms and tools and being able to use them. What I would advise is you can surely get some material on this. Some primary material is also available. Very nice YouTube videos are available. A couple of them I have sent you the link. Have use them. Okay, and there are some other tools available to understand this better. The only way to understand and get uh, say comfortable with it is by practicing, by using it everywhere. Okay, so then you can surely use it. So here is some time where we can have any additional discussion if you have any particular queries. Uh, I would also invite you to share your experience or your inputs so the discussion is enriched and everybody is benefited.
Good afternoon,
So
sir.
let me know if there is any particular query.
Good afternoon, sir.
Yes,
Sir, I would like to start question answer session with your permission.
yes, please.
Thank you, sir. Sir, the first question is, while carrying out financial analysis of any stream, whether we can consider the amount that invested in the embedded system of a plant. This question is by Dr. Bhusnur, sir. May I repeat the question, sir?
Uh, that would
May,
be easy.
Okay, yes. While carrying out financial analysis of any system, whether can we consider the amount that invested in embedded system of a plant?
Amount invested in the embedded system.
Of a plant.
So by that, do you mean? Okay, so whoever has asked this question, he is there. Is he there right now?
No, sir. He's on. He's watching on YouTube. So he has asked question in chat box of YouTube.
All
He
right,
is
fine.
Dr. Bhusnur, sir.
Okay.
Yes, sir.
Fine. I understand by embedded system, you mean the investment already done in the present system. So, for this particular financial analysis, okay, when we go for a financial analysis of energy conservation measure or new equipment that is coming in, generally we consider the new investment only. We don't go for any investment that is done before this project. So if something is already invested and if we are carrying out any retrofit or any improvement over that, then we will be considering or comparing the investment for these new improvements vis-a-vis the investment vis-a-vis the benefits of because of this new improvement. Okay, so no expenses prior to that or prior to this project would be considered in this financial analysis. I hope I am answering the question. But if there is any
Thank you, sir. There is one
further
more
detailing
question by
required,
him,
you may
sir.
please ask.
Sir, there is one more question by him. Uh,
Yes, please
can
tell
we
me.
consider the cost incurred due to effect on health and environment of any project while making its finance analysis?
Yes. Now, as we have seen the cash flow diagram, I will just go back to the presentation. Is this presentation visible?
Not yet, sir. Not yet.
I will share. Is it visible now?
Yes, sir.
Yes,
It is
sir.
visible.
Okay, good. Now, if we go here and if we see, so in the financial analysis, we consider both the benefits that we have, that is on the positive side, and the expenses that we incur. Okay. Now, if you ask me, should we consider also the expenses on the health and
Health and
other
environment
other
of any
problems,
project.
which health, health and environment, yeah.
Yes.
So when it comes to environment, particularly, if you have uh, let us say the penalties, okay, for any kind of emissions, and if this particular project is causing those emissions, then you have to pay for it, and then you have to also account for this. Now, whether the expenses on health of the people working is to be considered in this or not, it depends upon how do you generally account uh, your health expenses in your company. Now, the company to company it will change. Okay, some of the companies may be pretty conscious and they will account every expense on the projects. There can be organizations which have separate, which have a method to account it separately. You may account. It depends upon the policy. From energy point of view, I would say project should not be unnecessarily accounted for something that is not directly related to this particular project. That's
Okay,
it.
sir. Thank you. Now I'll conclude question answer session. Over to you, Priyanka ma'am. Thank you, sir.
Thank you, sir. It was indeed a very informative session. Now I request Professor Rehan to give vote of thanks.
Thank you, madam. It's my honor to propose a vote of thanks on this occasion. I, Professor Rehan Siddiqui, on behalf of MCT's Rajiv Gandhi Institute of Technology, Department of Mechanical Engineering, and on behalf of Organizing Committee of AICTE AQS sponsored online 1 week short-term training program on recent trends in energy management and audit, and my own behalf, extend a very hearty vote of thanks to Mr. Vinay Gadikar for accepting our invitation as a resource person and sparing his valuable time with us. He has given good insights on the topic of financial analysis of energy conservation projects through techniques like simple payback period, return on investment, savings to investment ratio, net present value, internal rate of return, and life cycle cost analysis. Thank you so much, sir. It was indeed a session filled with knowledge. Tomorrow, 25th November, we have a session on energy management system by Dinesh Mantri. I request all the participants to join the session at 10 a.m. Thank you. Thank you, everyone.
Thank you, Rehan, and all the organizing team. I actually enjoyed this. Uh, Now, the only closing note I can put is I would advise everybody to continue using these techniques so you can be good at it, and also you can promote these techniques in your coursework if you are taking it forward to your students. That's it. Thank you. Thanks a lot.
Thank you,
Thank
sir.
you